All right. Hello, everyone. We're back with another cast slash spreadsheet voiceover to explain the other two tabs of my spreadsheet. So last time I went over the one just for the stocks, the outperform, and all these nice data points that I have set up. The number of views was great. I didn't expect over 1,000 people to watch the first video overnight. Don't forget there's a second part to that video. It goes into some deeper explanation on some individual stocks that are currently meeting some of those outperform criteria. So I've pulled up the cyclical tab. Right now I have SPY, which is the S&P 500 ETF. Right now I've got a 50-day moving average as my comparison number that I'm going to go with. And basically this column over here, well, let me back up a little bit. So we got the date, close price. I've got a slope, which I'll get into. That's just the difference in price from day to day. I've got a moving average, and I've got a column that says sell or buy. And then I've got an attempt at calculating a 14-day relative strength index. That one was a bit of a doozy, but I think the relative strength index can give you a good idea of whether or not a stock is overbought, oversold, or in the middle even. And then I've got some stocks over here that I test that I identified that I wanted to test on this to see what their cyclical ranges look like. So, anyways, if I come down and I look at, I think I have about 90 days worth of data. No, I have 60 days worth of data. So 2 months worth, I've got the 50-day moving average. It's pretty close, 50-day moving average to 60 days. Decent average across the board, gives you a good idea. So these buy signals and sell signals. If it says sell, it means the price at that time is over the 50-day moving average. If it says buy, it means the price is below the 50-day moving average. So I try to use this to back check whether or not I could have bought and made some money. Now, take into account that the further back you go, the more the moving average would have been different on that day, especially if it was more than 50 days ago or 25 days ago. Okay, so just understand that these are not precise numbers, but if you do look, you can find some interesting correlations where, say, when SPY was 273 on the 21st of April, we could have bought it then after it had dropped $8.55 to below the moving average. That's a significant drop for SPY itself. So we flashed a buy point right here, and then hypothetically, if you had bought, you could be up to 292 on that investment as of the 8th of May. So that's about a week and a half, basically, up 20 points on an index. That's pretty impressive. Now, the market conditions right now are pretty volatile, so that can explain some of that. But what I have used this before was back testing, and I even made a trade on Snapchat a while back. It's not going to show up here. But basically, once upon a time, Snapchat a while ago had dropped to a buy signal. And it just so happened earnings was coming up, and the earnings were expected to beat the estimates. So I bought into Snapchat. I think I bought somewhere around $13, sold at 17. So that's a pretty good gain, and especially for not holding it very long. But if you take a look here, we've got a lot of buy signals. It's below the moving average, right? Now the moving average has probably gone up because the last couple weeks of data have been higher because Snapchat beat earnings again, right? But if you had taken the advice of this spreadsheet, and you maybe periodically bought here in the 12s, maybe the 11s, maybe around $10, and then you make that jump to $17, $18, that's another good way to profit. So this tends to be for this this part of the spreadsheet tends to be for stocks that have cycles that they go up a lot, then they go down a lot, and that kind of leads into my point about the slope. So if you notice, ideally the way that a graph works, a sinusoidal graph, right? It goes up to 1, it goes back down to 0, passes 0, goes to -1, and then goes back on the same type of sloping curve. With the stock market, we have that, but it's a little more on an uphill incline with the moving averages, actually. So it's very mathematically predictable in some regard. But if you notice when the stock starts to bottom out, say, um, it'll start to approach 0. So you'll have it go from negative to positive, back down to negative. You could say that that was a peak of some sort, right? So it went from 1354 to 1378 as the high, back down. So if you had bought back here, you've got buy, 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 and if it pops a sell signal, then that could tell you like, hey, this is kind of it's shot up above its average, right now, and you should sell before it gets low. All right, so we'll switch over to the sector chart. I don't want to take up too much of your time, but basically this sector chart, I've got ETFs that cover all the major sectors, so telecom, retail, oil, mining, consumer, discretionary. We got health, utilities, staples, tech, industry, finance, energy, materials, biotech, semiconductors, real estate, home builders. Then I've got the S&P 500 and the NASDAQ for comparison. The things I find to be most interesting with these is that, right now, and it makes sense with the economic situation due to the pandemic, that, utilities is down, industry and finance are down, real estate is down. But in other situations, say the tech bubble had burst or something like that. I mean, you would have all your technical stocks down, and then your industry, your utilities, they would probably be gaining or something like that, right? So this can tell you kind of like, okay, so now's not a great time to buy, say, into tech stocks because they're pretty high. I mean, they're over both their averages. But if you bought into utilities, industry, finance, and real estate, they're all battered industries right now. And, you'll find that information in the news, but this is more of a mathematical confirmation of that information. And the other thing I find interesting with this is that if you take a look at the growth rates, you can also see what industries have not been performing well over the past, 5 years. So we got retail, oil, and mining have all been on a steady decline. But if we go down and we take a look at tech, we've got 119% gain over the last 5 years, 30% gain in the last 1 year, right? If you look at energy, negative for 1 year growth, negative for 5 year growth. And I think that's because they rely heavily on oil prices to sustain their business. And then if you take a look at biotech and semiconductors, both green, both growing. Semiconductors are up 139% over the last 5 years. I mean, that's pretty hard to compete with, right? And then you can even compare the major indexes. So the S&P 500, SPY versus NASDAQ, which is QQQ. 5 year performance, we got the S&P 500 37%, NASDAQ 107%, and NASDAQ is largely tech stocks, right? So just more confirmation of what we already basically know to be true, that tech grows faster than a lot of the other industries. And then so this isn't really for buying, selling, and trading ETFs because they don't move a lot. They're not very volatile. But what this can do is it can tell you, hey, maybe I should look into utilities. Maybe I should look into industry, finance, and real estate because they're battered right now. Their stocks are low. Maybe I can get in at a discount and get more for my money, more value for my money if I buy, a good company that just happens to be low right now because of the situation. If their fundamentals are good, if they've got cash flow, if their business is still relevant and they're still making progress in the right direction, then you could argue that that might be a good investment. Again, I'm not a financial advisor. This is not trading advice. Do your own research, your own due diligence, and good luck with your trades. Thank you very much for listening.